Back in 2019, when Asia Partners was just getting started, they published a study that made 8 very specific predictions on how Southeast Asia's tech ecosystem would evolve over the next decade, with measurable targets by 2029. That report has become an annual tradition, and each year the team looks back at those 8 predictions and holds themselves accountable to see how right or wrong they were. It has become one of the most popular sections of each year's report, 4 years running. Oliver Ripple is one of the co-founders of Asia Partners and has a very unique background. He's half German, half Korean, or a Kerman, as he likes to say. After 9 years with eBay across Europe, Korea, and Southeast Asia, he then became an executive at Naspers, one of the world's largest internet conglomerates, where he rose to become their global CEO of all business-to-consumer e-commerce investing. Oliver's investment in Flipkart on behalf of Naspers was one of the best tech trade sale exits in Asia's history, earning Naspers $1.6 billion of net gain in cash and a 29% IRR. Oliver, wonderful to be with you. Why did you make such specific predictions back in 2019? Isn't the old rule of thumb of management consulting that it's better to be directionally right than specifically wrong?
Well, that's why I'm not a consultant. All of us at a senior level at Asia Partners are what we call investor operators or operator investors. We've each done time in the trenches as operating executives at companies, and we've also each spent time as investors before founding the firm together. We have a lot of respect for startup founders who set a specific plan and then go hit those numbers. And we felt it was only appropriate that we put our own necks on the line with a forecast and then hold ourselves accountable each year, just like measuring actuals versus budget for a company.
Take us through the 8 predictions for 2029, one by one, if you will. You're about 4 years in, give or take a little, since 2019. So how have they turned out so far?
Well, we let you be the judge. Let's start with the first one, which was that Southeast Asia was entering what we called its golden age. That's not just a slogan, it's a very specific period of time when a country's GDP per capita is $4,000 to $8,000 per person in 2023 dollars. What you see on this page is something quite beautiful actually, not the chart itself, but what it stands for. This is the journey how Asia built its middle class, one country at a time. Japan was first out of the gates, going all the way back to the 19th century, followed by Korea, then China, and now us in Southeast Asia. You can see that Japan, Korea, and China each went through that formative zone of $4,000 to $8,000 per capita. Japan from 1955 to 66, Korea from 1979 to 89, and China from 2014 to 15. They are all well past the golden age now in terms of affluence. We are the only major part of Asia in it right now, at about $6,000 of GDP per capita, and will be there for several more years. India isn't there yet, but should get there by the early 2030s. You can set a reminder in your calendar. What's important about this zone, $4,000 to $8,000, is it's when really large technology companies go public. Or more precisely, it's when the companies that eventually become big first go public. Consider the following. China was in that zone from 2004 to 2015. A bunch of tech companies went public before then, and a lot have gone public since then. But if we look at the golden age years, plus or minus a few years, 59% of today's current tech market cap is from companies that went public during those years. That's $1.9 trillion of market cap. It's just staggering. And it's not just China. Look at Korea. It's a smaller country, so the data is more lumpy, but if we apply the same filter, 58% of Korea's current tech market cap originally went public in its golden age, plus or minus a few years. Japan hasn't been in its golden age for 2 generations, but you can still see the echo of its golden age in the 25% of its current tech market cap from companies that went public from its zone. As Euclid said, 2 points make a line. Here we have actually 3. And there's a lot of data to suggest that Southeast Asia, as the next region of Asia to go through the golden age affluence zone, could be next. Which means that the companies that go public in the 2020s might do some very interesting things over time.
This is empirically interesting, but why does this happen?
It's like the old joke. It works in practice, but does it work in theory? There are probably many reasons, but we'd suggest 2. First, you see a dramatic rise in discretionary income as countries approach and then enter the golden age. If we use the gross savings rate as a percentage of GDP, you see that very clearly for China, Korea, and Japan. Second, there's some anecdotal evidence to suggest that after the golden age, things get more oligopolistic in terms of major incumbents that start to get bigger and bigger. You started to hear the BAT acronym for Baidu, Alibaba, Tencent in the 2010s, for example, as China was exiting its golden age. The second prediction we made was that there was a very specific type of technology business model which would work very well for startups in Southeast Asia, and that most of the successful startups from our region would adopt it. That's turned out to be correct. In fact, it's one of the core pillars of what we're looking for in our investment selection criteria. Imagine you had a bonsai tree with 3 branches. One branch would be most of the world's tech market cap. These are businesses with powerful network effects, and those network effects don't have a geographical limit. They're global. You know it's a category 1 on the bonsai tree when the Google of Thailand is Google and the Facebook of Indonesia is Facebook. These are very interesting companies, but they tend, by and large, to be launched out in the West. A fascinating and inspiring exception to that rule is, of course, ByteDance, and we hope that Asia will produce more over time. A second category is what we call the unique local winners, where the regulators have, for one reason or another, unleveled the playing field. We tend to avoid those kind of companies in Southeast Asia, and thankfully there aren't that many of them. Where we focus is on the third branch, and this is quite interesting. The mere existence of this third branch was arguably quite controversial, or at least underappreciated 10 or 15 years ago. That's where life experience really helps. I was part of eBay's adventure in China many years ago when we bought EachNet, which had 80% share of the country's e-commerce market, and got defeated by a little-known company from Hangzhou called, you guessed it, Alibaba. It wasn't that the government gave Alibaba an advantage per se. The company we bought already had 80% market share. It was that there was something inherently local about marketplace e-commerce that gave a local team with a keen sense of local consumer needs a decided advantage over time.
Is there just that one Category 3 model, e-commerce?
We think there are several, actually. The interesting thing is that often Cat 3 bonsai models are actually invented in the West, but when they come to Asia, it's often the local girl or local boy that ends up dominating the category. Again, not because of regulatory help, but there's simply an advantage of being on the ground and very attuned to customer needs. We've seen this movie play out in e-commerce, certainly, but also in many other categories like online travel, games, education, cars, real estate, healthcare, ride-sharing, and also marketing. Any internet category where there's something very local about the execution and you can't simply run it from an air-conditioned central business district building.
Okay, but the counterpoint here would be that these are niche markets versus, say, the Google global search franchise. How big can those Cat 3 companies get?
Those were actually our third and fourth prediction. We predicted there would be at least 20 more billion-dollar value tech companies from Southeast Asia by 2029, and half would go public. You have to go back down memory lane to 2019 to remember how gutsy that prediction was. Only C had gone public, and it had a tough first year in the markets as a public company. There was a lot of talk about C being a one-off, a bit of a fluke, which is why we were delighted to see that it's not just 1 or 2, but 7 more tech companies have gone public in Southeast Asia at a $1 billion valuation or greater since our 2019 prediction. In fact, 2 of those were in 2022, which around the world was a tough year for IPOs. All it will take is for 3 more companies to go public in the next 6 years, and we'll be at our target of 10 more. But we think it will actually be more than that.
How did you pick the number 10 to begin with?
If you look at China's journey through the late 1990s and then its golden age and beyond systematically, there's a very interesting pattern that emerges. This chart has been a bit of a labor of love for us to put together. It shows you every tech IPO from China since the very beginning of tech IPOs in 1995. It was only in 1990 that the Shanghai exchange reopened and the Shenzhen exchange opened, and in 1993 that the first mainland company listed on the Hong Kong Stock Exchange. So 1995 was really very early on. We like to call this chart the periodic table, like in chemistry, And what you see on this chart are 4 waves of IPOs. First came the telecom infrastructure IPOs, starting in the mid-1990s. Then Web 1.0, which almost everywhere in the world is online ads, online games, and online travel. Then e-commerce, and finally online services like fintech and food delivery. This is intellectually interesting, but what's more powerful is to compare the chart for China with the equivalent chart for Southeast Asia. And what you see is that Southeast Asia's chart is only half written. There are plenty of rows where there isn't a single public company yet, but we know from the bonsai analogy that many of those rows are bonsai cat tree models that should exist in every part of the world, built by local entrepreneurs with on-the-ground networks. Counting down those empty rows were the genesis of the prediction of 10 more IPOs, and it's exactly how we've been investing at Asia Partners. Our portfolio corresponds quite closely to those empty rows on the chart for Southeast Asia, almost like painting by number. We sincerely hope that many of them will become public companies in the not-so-distant future, putting new rectangles on the chart.
Now, you've mentioned you're already at 7 out of the 10, but what could still go wrong over the next 10 years?
Yeah, something we do worry about is the still underdeveloped equity research ecosystem in Southeast Asia. It's something to consider, and we hope that the investment banks will find a way to make this a priority. A simple search on LinkedIn suggests that Singapore has only 63 equity research analysts to cover newly public companies, versus 305 in Hong Kong. That infrastructure was carefully built up in Hong Kong to support China's IPOs over the past 30 years, and we need to build that up here as well.
It looks like you didn't get the next one quite as right, or am I being too harsh?
Well, the facts are the facts. We predicted there would be an additional 400 billion of market cap in tech by 2029. 4 years in, we are 15% of the way there, rather than the 40% of the way there. So we are behind schedule.
Where did the $400 billion number come from?
Back in 2019, Southeast Asia's total tech market cap as a percentage of GDP was just 2.2%. China was already at 16.6%. And that percentage had gone up over time to get to there. We felt there was a good chance that Southeast Asia would be there at 16 to 17% by 2029, which meant that without even taking into account an increase in GDP over the next 10 years, we'd have an additional $426 billion of equity value. For the record, if you look back a year ago, we were well ahead of schedule, with C's market cap being a major driver of that. The biggest driver of the change has been the correction in C's share price since the late 2021. But with 6 years still to go, we are still cautiously optimistic that we'll hit and perhaps even exceed the target for 2029.
One of the biggest differences between Southeast Asia and, say, China is that Southeast Asia is multiple countries rather than just one. In fact, there are some people who say that Southeast Asia shouldn't even be called a region. It's more of just a grouping of countries that happen to be geographically between India, China, and Australia. What is your view?
That was the heart of our next prediction, and it's been on the mark. Every person who says that Southeast Asia isn't an addressable region has to confront the very relevant fact that C today, which is very intentionally regional in scope, is a $27 billion market cap company, and Grab, which is also intentionally regional, a $14 billion market cap company. And that's one of the single biggest changes in our region since I first began working here over 12 years ago. It is now possible, full stop, to build regional companies, especially in tech. There are multiple proof points of how to do this, but it's not easy, and there is a very specific playbook for how to do it. It's helpful to start with what we call the chessboard, basically a summary of the key strengths and weaknesses of each of the 6 major economies in the region. Some have a lot of GDP, like Indonesia and Thailand. Others have population. Half have programmers in quantity, and 2 have reasonably decent capital markets. But only 2 are good springboards for building a regional company. And interestingly, those are the 2 former British colonies, Singapore and Malaysia. Not surprisingly, they're also the 2 smallest among the 6 in population, which means they've been running out of a domestic market for a long time and have learned to expand abroad. The way this plays out is that there are 2 core strategies we see. Strategy 1, where you just focus on Indonesia, and Strategy 2, where you go regionally. We are constantly on the lookout to see if a viable Strategy 3, which could be a single country, Vietnam, Thailand or Philippines, will emerge, but it may still be a little early. The way in which you execute against Strategy 1 or Strategy 2 is very, very different. and therein is a source of competitive advantage, part and parcel of the bonsai category 3 thesis. Take a look at this chart. On the right, you see two representative local subsidiaries of global tech companies, Microsoft and Tencent. See how close to half of their people are just in Singapore? That's a classic playbook for someone coming in from abroad, and it has its limitations. Now look at the Strategy 1 and Strategy 2 companies. They are much more local. The Strategy 1 companies have virtually all of their people on the ground in Indonesia. And even in Strategy 2, no more than 10 to 12% of their people are in Singapore. The rest are fanned out across the region, building the business at a local level. This page is sort of a textbook example of why there's a third branch to the bonsai tree.
Why is Singapore the hub for Strategy 2?
Whenever you have a region of the world with multiple countries, it's often the case that one country and even one city becomes the hub for commerce. In Europe, it's clearly the UK, and within that London. In the Middle East, it's far and away Dubai. And in Southeast Asia, Singapore has long been the region's hub. What's quite impressive is that, quietly, Singapore has also become Asia's hub. If you look on LinkedIn for people with Asia Pacific, Asia or APAC in their job title, 25% of those people globally are based in Singapore. We like to say that Singapore is an overnight success that was 100 years in the making. If you take the long view, Singapore has steadily, patiently earned its success over time. It reached parity with the UK in 1993 in terms of GDP per capita, then in my home country of Germany in 1994, then Japan in 1997, and then the US not just a couple of years back, but 15 years ago. Part of why Singapore keeps rising is that it keeps reinventing itself. It's a long forgotten fact that Singapore used to be the hard drive capital of the world. Almost half of the world's hard drives came out of Singapore in the 1980s and 90s. Then it became a financial services and travel hub. Now it's an internet hub. It's actually very exciting to watch. And the other thing to watch is that Singapore is becoming a hub for global family offices. China's rise is part of this, but so is the rule of law and stability that Singapore offers. We think there's a very good chance that the world's next BlackRock might very well be built here in Singapore.
Many of those family offices from China are for successful entrepreneurs who were, not all that long ago, startup founders themselves. And many of those China founders came out of its first generation of tech platforms. So are you seeing that dynamic in Southeast Asia, a sort of PayPal mafia, so to speak?
Yeah, very much so. That was the core of our next prediction. This one is also better than we thought it would be, but we can't take too much credit. We probably undersampled the pool of academy companies in the first time around in 2019.
Academy companies?
There was a great article in the Wall Street Journal in January 2023 about how half of the head coaches in the US NFL are the proteges of just 2 other coaches. The same thing is true in Southeast Asia. A lot of great founders come out of a handful of talent factories, which we called the academy companies. Look at this back in 2019. The 10 companies on this page had already produced about 1,200 startup founders, which is what you get when you add up the rightmost column. Rolling this forward and looking at just those 10 academies again, the number is now 2,700. That's partly because now we look at both founders and CEOs. After all, Tom Watson didn't found IBM, but he surely helped to build it, but also because of the passage of time. It's remarkable. But where we erred in 2019 was in limiting the academies to just 10. There are actually far more, including the telcos and even semiconductor companies like Intel. After all, until C, Grab and others, tech in Southeast Asia was largely 20th century tech companies. They produced a lot of alumni. If we look at the broader aperture, there are another 3,000 or so founders and CEOs they've recycled back into the ecosystem. This is very powerful.
What about founders coming to Southeast Asia from other parts of Asia?
That's another very powerful trend. Back to the periodic table and the Golden Age charts, China and Korea are 10 to 40 years ahead of us. There's a lot our region can learn from their entrepreneurs. And in parallel, India is just to our west and has a superb higher system of higher education. One of the things we've started tracking is how many alumni of the top 55 or so universities in China are now working in Southeast Asia's tech industry. Just based on LinkedIn profiles, it's at least 13,000 people. 557 of them are now founders or CEOs, and that number seems to be growing almost by the day. When we first went looking for this in November 2022, around Thanksgiving, it was just 536. Now it's 557, or one every 3 days. The same is true for graduates from India's top universities. There are over 9,000 of them here in the region's tech industry, and 490 are founders or CEOs. And ditto for Korea, my mother's home country. Over 6,000 graduates here, of which 240 are CEOs. It's particularly interesting to see how many have founded companies in Indonesia, almost 20%, which is 2x the ratio from China and 3x the ratio from India.
Interesting. Well, by my count, we're up to 7 predictions. So what was the final prediction?
The Series C-D gap. It was both a prediction that Southeast Asia was now investable for growth equity size checks, as opposed to just venture capital bite sizes, and a statement of fact, which was that there was an acute supply gap in the Series C-D band.
Did you get it right?
By and large, with the exception of 2021, when pretty much everything in the world was oversupplied with capital, almost every country, almost every industry, almost every stage, Southeast Asia was not an exception. But what we're seeing now is a dramatic pullback in capital supply, which we can quantify almost in real time, and that's bringing the Series C-D gap back as a prominent feature. To provide some context, think of venture capital and growth equity funding for tech companies as a continuum from seed all the way to IPO and beyond. In our part of the world, seed tends to be under $1 million, Series A and B between $1 to $20 million, and Series C and D between $20 to $100 million. There are exceptions, but that's a pretty good rule of thumb. The seed ecosystem is quite active but hard to quantify. If we go one step up the ladder to Series A and B, what's evident is a very robust expansion in capital supply in recent years. From 2015 to 2022, our upstream brethren in the Series A and B community made over 1,300 investments. There were over 900 in just the past 4 years. 2022 was more than 3.5x 2015. Each way you look at it, this is a thriving segment on the continuum. Now let's keep climbing the ladder to Series C and D. There's a great database we subscribe to which lets us build up the actual amount of capital supplied in the $20 to $100 million size range, deal by deal, quarter by quarter over the past decade. What we do is add up all those deals in China and then index that to the total size of China's GDP at that moment in time. And then we do the same math for Southeast Asia's deals, recognizing that our GDP is of course smaller. This makes it an apples to apples comparison, not apples to Samsung.
Apples to Samsung. I like that. I could have used that in my news days.
What can I say? I'm half Korean. What that tells you is that for most of the past decade, there was a gap to China of about 3.6 basis points. That may not seem like much, but multiply it by $3 trillion of GDP in Southeast Asia, and it adds up. There was a brief period of time from late 2020 to mid-2022 when the entire world was oversupplied with capital. Southeast Asia and China were no exception, and there were even a few quarters where we indexed slightly higher. It's a key reason why we at Asia Partners paused on all new investments for about 12 months between mid-2021 and mid-2022, and we're fortunate that we did. And now, looking at Q4 2022, you can see that capital supply is in free fall. That's a very interesting dynamic for folks with dry powder.
Is China the right comparison or simply the only comparison?
Historically, because of the periodic table analysis and the fact that their golden age was just a few years ahead of ours, it was. But we also want to learn from other parts of Asia. We found that there's a gentle relationship between a country's GDP per capita and the amount of its growth equity capital for tech companies, the latter measured as a percent of GDP. You can see this with the progression of Southeast Asia in light blue, China in black, and Korea in dark blue. And you can see what an aberration 2021 and even the first half of 2022 was. And you can see how things have normalized again back in the second half of 2022 with capital supply again in free fall.
Why is India so high for where it is on the affluent scale?
It's a great mystery to us. It feels for us to be very oversupplied with capital. I remember that even only a few years ago, we estimated that the total addressable market of customers for us was perhaps no more than 60 million people out of a population today of 1.4 billion. That will grow as India enters the golden age in the early 2030s, but it can't happen overnight. That said, we do look at both China and India as a reference point and as a mathematical matter relevant to India's supply of capital over the past few years and China's supply of capital over the past few years, indexed to GDP, Southeast Asia is still undersupplied with Series C and D capital. We can look at this a few ways to get a precise handle on it. First, we can benchmark to China or to India. Once we have a point of reference with one of our neighbors, within Southeast Asia we can look at capital going to strategy 1 or strategy 2. That's the Indonesia-only strategy or the pan-regional strategy. We can look at the gap relative to the benchmark for Series A and B, Series C, Series D, and then beyond. And finally, we can look at this for the full year 2022, which includes the leftover exuberance of 2021, or just the final quarter of 2022, which is very different. This first chart looks at the under or oversupply relative to China, looking at Southeast Asia's full year 2022 versus the average in China over the last few years. The scale means that, pound for pound, the capital supply is equivalent to China. A thumbs up is from the investor perspective. That particular segment in Southeast Asia is undersupplied. And a thumbs down is also from the investor perspective. That particular segment in Southeast Asia is oversupplied. From the standpoint of a startup raising capital, the thumbs would flip. What you see is that, relative to China, there were a lot of red thumbs down across the region in full year 2022, largely because 2021's euphoria hadn't fully tapered down in the first half of the year. However, if we zoom into Q4 2022, it's a very different picture. A lot more green thumbs up, which is great news for growth equity LPs. Needless to say, if you benchmark to India, everything's a thumbs up everywhere. That's true regardless of whether we look at the full year or just the fourth quarter. So to summarize, we didn't get them all right, but with several years still to go until 2029, I think an objective score would be pretty good. We are excited to see what our final score will be in 6 years.